Nigeria's economic growth slowed to 3.98% year-on-year in the third quarter of 2025 from 4.23% year-on-year in Q2. This was as inflation and tight monetary policy weighed on activity. Economic expansion in the July to September period was driven by growth in services and agriculture, as well as rising oil production. The economy expanded by 3.13% in the first 3 months of this year after updated calculations following a rebasing of its gross domestic product. Nigeria's public debt stock, which includes external and domestic debt, stood at 152.39 trillion naira. That's $99.65 billion in Q2 2025 from 149.38 trillion naira. That's $97.23 billion in Q1 2025, indicating a growth rate of 2.01% on a quarter-on-quarter basis. Total external debt stood at 71.84 trillion naira. That's $46.98 billion in Q2 2025. Still on the Nigerian economy, the Stanbic IBTC Bank of Nigeria Purchasing Managers Index inched down to 53.6 in November 2025 from 54 in the previous month, notching a full year of monthly expansion. New orders supported by new products and stronger customer demand and growing output across all the major sectors was aided by easing inflationary pressures. Employment increased modestly as purchasing activity accelerated to a 7-month high, helping inventories to rise at the fastest rate since mid-2023. According to the release, research analysts see both manufacturing and services growing faster in 2025 compared to 2024. Also, lower interest rates in line with lower inflation and exchange rate stabilization are expected to help private consumption and business investments in 2026. Other analysts are still more guarded on their growth expectations, at best presenting a mixed picture with progress tempered by evident fragility. Following the GDP rebasing exercise, Nigeria recorded 3.4% growth in 2024, up from 3% in 2023, driven by ICT, real estate and trade, agriculture remaining resilient at modest levels, while manufacturing lagged behind. In the first half of 2025, growth averaged 3.7%, maintaining a higher level compared to 2.9% in H1 2024. There are themes to watch in 2026. They will include acceleration of reforms to drive especially industrialization and enterprise growth. Second is investment in infrastructure for competitiveness, with priority on reliable power, efficient logistics, and digital connectivity. FDI inflows certainly still need some attention as Nigeria signals that it is open, predictable, and now has a fair environment for investors. Other key issues, of course, will include fiscal sustainability, strengthening our institutions, and perhaps most importantly, addressing more vigorously the issue of reforms in the security ecosystem. According to the Nigerian Economic Summit Group, the government vision of a $1 trillion economy by 2030 requires an annual GDP acceleration of 15% a year, which is optimistic and requires very, very ambitious reforms. But more realistically, $700 billion GDP by 2030 can be achieved if we continue to see inflation fall to single digits, FX stability, and investment inflows also improving, with achieving this time 7 to 10% GDP growth. According to NESG, business as usual, that is where we are now, will deliver 3 to 4% GDP growth. That would take us nowhere near $1 trillion. Stanbic IBTC, in their latest Purchasing Managers Index report, according to their research, they expect 4% GDP growth this year. Chika Mbonu, who is CEO and the Managing Director of KSBC, that's Knowledge Resources Limited, comments on the economic outlook for Nigeria in 2026.
2026 will be Nigeria be in the stabilization mode, not really expansion mode, but I'm just going to say that the key reform initiatives, the post-reform effects of 2023 to 2025 will begin to settle, and as government continues to focus on FX stability, food security, and the revenue expansion, as we know about, I believe that businesses will leave the uncertainties of the previous years of survival to move towards planning. Of course, we know that one of the things that happened is the banks have had to provide so much for the loans in their books because of the uncertainties and economic situation challenges. I believe that banks will also recalibrate their credit models. Inflation, we believe, will moderate, will continue to go downwards, will continue to moderate. I mean, depending on who we talk to, between 12 to 18%, as I say. Food inflation, we believe, will continue to slow down as production improves. And the FX-driven inflation will also reduce due to more stable exchange rate. And core inflation is still elevated, but we believe that to be more manageable. The other thing, of course, that's key to Nigerian is foreign exchange. Everyone talks about foreign exchange rate. Depending on the model you look at, the best case is people think it's going to trade between 1250 to 1500, and CBN continues to keep it within that band. We believe that with the increase in crude oil production, Dangote refinery reducing petroleum import and FX demand, and investor confidence returning back to the economy. We believe that the FX dollar exchange rate will begin to stabilize and strengthen within the bands that I talked about already. Interest rates will continue to remain high into mid of 2026, I believe, and the gradual easing by central bank will commence maybe from Q2, and then lending rates will still be elevated in 2026 to about 25%, 30%. Before I even end this my brief talk, one of the things I'm going to look at is I think 2026, everybody's already getting scared. It's going to be a tax year, the beginning of the new tax regime for Nigeria as government aggressively expands tax collection, and then the more digital monitoring of businesses. So this is going to be a major issue for 2025, and I believe the corporates, especially those who have not been paying taxes, should just get ready for that. Maybe, of course, higher revenues from oil and non-oil sources, but debt service will continue to remain heavy as well, not really, and government continues to borrow domestically. As I said earlier, these fiscal pressures will lead to government to be more aggressive on tax enforcement. For the corporate also, I believe that you're going to have increased documentation and reporting burdens and the higher need for financial literacy and support for and a little more scrutiny for digital transactions. Well, I mean, as I said, 2026 is going to be a year for not really expansion, but more of stabilization for Nigeria.
Hello, this is Global Business Insights, and I am Bode Oshosami, where we consider in more depth the stories making headlines and what it means for business persons. To more global PMI releases, shedding more clues on how global economies are ending the year. In China, manufacturing activity declined for the eighth consecutive month in November to 49.2, but still slightly higher than the October print. China's economy is still hurting from effects of a global trade war and weak domestic demand. The Hamburg Commercial Bank Eurozone Manufacturing PMI was revised lower to 49.6 in November 2025 from a preliminary flash of 49.7. It was also the lowest reading in 5 months and lower than the 50 PMI prints that we saw in October. And in the UK, S&P Global UK Manufacturing Purchasing Managers Index inched up to 50.2 in November from 49.7 in October. It was the first reading above the neutral 50.0 level since September 2024, as output also expanded for the second consecutive month. November saw stronger domestic demand and a softer decline in export orders, while new orders stabilized after a 13-month contraction. As the UK continued to digest Chancellor Richard Reeves' last week's budget statement, Britain's fiscal watchdog, the Office for Budget Responsibility, says the early release of details of Finance Minister Richard Reeves' budget last week was due to failings in its leadership. It has committed to publish findings from an investigation into the reasons for the early publication and to improve its systems. Meanwhile, Richard Hughes, the chair of the Office for Budget Responsibility, has resigned after the findings of an urgent inquiry by the watchdog into how it inadvertently published Richard Reeves' budget 40 minutes early. And in the US, November's S&P Global Manufacturing PMI was 52.2, slightly above the preliminary reading of 51.9, but below October's final reading of 52.5. It was another month of solid, though moderating improvement in operating conditions across the sector, underpinned by the strongest rise in output since August and supported in part by a pickup in new orders. Still, overall demand expanded only modestly amid a lingering market uncertainty. The artificial intelligence momentum is not in any way abating as NVIDIA invests another $2 billion in chip design software maker Synopsys. It also strengthens NVIDIA's alliances and partnerships in the artificial intelligence ecosystem amid concerns of increasingly circular deals and competition. OPEC Plus over the weekend confirmed it will keep output unchanged for the first quarter of 2026 amid oversupply fears. The group also approved a new mechanism to reassess member countries' maximum sustainable production capacities to be completed by September 2026. The OPEC decision signals a cautious approach to market stability while laying groundwork for smoother quota negotiations. Oil prices ticked higher after the news. Asia Pacific markets were mixed as traders considered fresh manufacturing data from China and rising expectations of a US Federal Reserve rate cut this month. Traders are now pricing in an 87.4% chance of a quarter point rate cut for the upcoming Fed meeting on December 10. The S&P 500 and the Nasdaq were both falling on the first trading day of December after a strong rally to end November. European stocks also kicked off the last trading month of the year, mostly in negative territory. Well, that's it on this special edition of Global Business Insights. Thanks for watching. This is Bode Oshosami. Bye-bye.